Some of the confusion when it comes to the mining companies or junior mining companies is the financing side. Yes, you do need to understand how the process of how a particular commodity goes from exploration to evaluation of the deposit, and all the studies to the development and then to the production. But along with this process, the big part of it is financing. You see, with regular companies, they might have gone public to either cash out the original backers, and then a lot of times after they go public, the companies just keep generating profits and don't necessarily have to come back to raise more money. And that's why the generalists are so opposed to dilution. But when it comes to the development process of a particular deposit, all of this is capital intensive. I mean, think about this. If you, let's say, thought that in your backyard there's oil or copper or gold or whatever, well, just because you think that there's something there doesn't mean it's there, right? So to find out, you have to drill. Well, drilling is expensive. It can cost like $250 per meter to drill one hole, and if, let's say, you have to take it all the way down to 400 meters, 400 times $250, $100,000 for one hole. Do you have that kind of money? If you do, then yes, you can go ahead and pay someone to drill a hole and for $100,000, and then send it to a lab and find out what the results are. And then if you have to drill 10 holes, that's $1 million. If you have to drill 100 holes, that's what? 10 holes would be $1 million, 100, 10 million, right? Do you have $10 million? Well, no, most people don't have that. So when it comes to these entrepreneurs that think they found something and they need to finance it, finance the drilling, how are they going to get the money for the drilling? Well, it can come from their savings. Do you think they can go to the bank and say, hey, can I get a loan and to poke a bunch of holes in my backyard? Of course not. The bank is not going to do this, because for a bank, such an endeavor is way too risky. So depending on different stages of a deposit, there are different risk levels. So I have this chart here for different entities, and as you can see, we have explorers, evaluators, developers, and producers. And as you can see, for the explorers, pretty much the only financing option that they have is equity. Yeah, dilution, that's what it means. There are no revenues at this point yet. So the only person that's going to give them money is equity investor, because the risk is too high for anyone else. Now, after we move from the exploration stage to evaluation stage, where you already know you have something, right? Now it's a matter of proving how big it is it economic, and all these sorts of things. That's the evaluation process. Well, it's a little bit less risky than purely exploration, where you have nothing there and you're looking for something. Well, at that point, the evaluators, what are their financing options? Well, equity, yes, they can raise equity, but they also have alternative ways of financing. And I'm not going to talk about some of the alternative ways, but I'll just give you a few examples. Like maybe they can put on a royalty, or get a streaming deal, or whatever. It's an alternative way of financing. Now, after after a particular deposit has been evaluated, meaning that it will have feasibility study, bankable feasibility studies, we know what the economics are, we know what the NPV is, we know what it's going to cost to develop it, we move into the developing stage. And at that stage, what are the financing options at that stage? Well, it could be equity. There could always be equity. Alternative financing is still available at that point, assuming that the deposit is good enough for anyone to be interested in it. But at that point, you also have debt. At that point, certain banking institutions will find it interesting, because now they have real numbers that they can base their lending decisions on. You've proven to them that this is what the future revenues are going to be. This is what the expenses are going to be. This is how much it's going to cost to build it. This is what the IRR is going to be. This is what the NPV is. Now the bankers like numbers. So at that point, debt is available. And once a project is developed and is already producing, well, it's even less. At that point, it's most likely in the hands of some kind of big mining company. Well, at that point, the project has been even more de-risked, because now not only do we have projections of what the project is going to make, now we have real money coming in, now we have real productions, now we really know what this thing is about. So at that point, when the project is producing, now what are the financing options that we have right now? Well, we have equity, we still have alternative financing, whether it's streaming or royalty or whatever. We also have debt, but we also have cash flow. That's a financing option. And you might think about, well, for producers, why would they need more financing? Well, the project can be expanded, right? The production can be increased, and it all costs money. And you know, that money can come from these sources now. Again, equity, alternative financing, it could be debt, but now they could even raise money at the corporate level. They could even not just have debt at the property level, they could raise bonds at the corporate level. So it's a whole new set of options becomes available. And most importantly, hopefully cash flow. It's not unusual to see projects put into initial production and then the cash flow used from that production to expand it into the ultimate production that it was originally designed to. So understanding financing is important, because without financing, nothing can be done. And when it comes to risky-less level of the project, when it's at the riskiest stage, which is at the beginning, equity is most likely the only way that the project can be financed. And as you know, equity is the most expensive, it's the most dilutive. As the project gets de-risked, more financing options become available, and they become cheaper, because obviously debt is less dilutive than equity. So I hope this helps, and let's move on to the next subject.